Hi, I'm Arjun Patsati, INR Bonds, and in this week of Search for Yields, our weekly newsletter video, I'm going to explain to you all about floating rate bonds and floating rate mutual fund schemes. Now, there is a lot of interest amongst investors in investing in floating rate bonds or floating rate funds. And the reason is that when there is the interest rates, as we all know, are at very low levels. They're at record low levels, and with the economy picking up and many other things, which is positive for inflation. Inflation expectations are rising, and this could also mean that as we go along, interest rates will also rise. So investors think that to protect them against rising interest rates and against their fixed income investments in a rising interest rates, they believe floating rate bonds or floating rate mutual fund schemes will provide a good investment alternative to fixed rate bonds or fixed rate fund schemes. However, while the concept of floaters is very good, it comes with a lot of risks, and investors must be aware of the risks and take an informed decision on investing in floating rate bonds. There are other ways to create a floating rate portfolio without investing in floating rate bonds, but we will talk about it in forthcoming editions of Search for Yields. So let's come to what are floating rate bonds. So basically, floating rate bonds are bonds that do not have a fixed coupon rate. So the difference is, supposing you have a Government of India bond, which is maturing in 2031 and carries an coupon rate of 6.10%. So every half year, the government will pay an annual rate of 6.10%. That is, every year they'll pay 6.10% to the investor. However, in floating rate bond, this 6.10% is not fixed. So it will change depending upon the change in a benchmark reference rate. So every floating rate bond will have one reference rate. I will explain to you with an example of a Government of India bond, floating rate bond. And when this benchmark reference, the very simple fact is that when this benchmark interest rates rise, then the coupon rate on the floater will also rise, and investors will get higher returns on their investment. And when benchmark interest rate falls, the coupon rate will also fall, and investors will get lower return on their investment. So typically, when there is expectations of inflation, which will lead to interest rates rising, then that's when investors look to invest in floating rate bonds. So taking this example of a Government of India floating rate bond, so the Government of India issues floating rate bond to auctions on a regular basis. And this floating rate bond is a benchmark against a 364-day treasury bill. This is a money market instrument issued by the Government of India to manage its short-term finances, while longer-term bonds are called dated securities, and that is issued for a longer-term purpose to manage its whole fiscal deficit process. And this floating rate bond is, like I said, is benchmarked to the 364-day treasury bill. And we saw in the last, the Government of India issued one bond recently where the reference rate of the 364-day treasury bill was 3.4%. And the bond first coupon rate was set at 4.04%, which is 0.64% over the 3.4% rate. So let's take one scenario where the yield on the 364-day treasury bill increases to 4%. So the next coupon rate, which is on a semi-annual basis, typically if the spread remains the same at 0.64%, the next coupon rate will be set at 4.04%. 0.64%. And if the treasury bill rate falls to 3%, then the coupon rate will be set at 3.64%, so which is lower than 4.04%. So clearly it shows you that when interest rates are rising, that is when treasury bill yield rises, then investors will get higher in coupon rate, which is positive for them. And when interest rates fall, investors will get lower interest rate, which is negative for them because they will earn lower returns. So clearly, it is only when interest rates are going to go up should investors look to invest in floating rate bonds. However, even this in the interest rates, benchmark interest rates can be volatile, and one never knows over the period of time where inflation will rise or not rise, or how long will it take for them to rise, and that is a question mark. Now coming down to floating rate funds. Floating rate funds are mutual fund schemes that float these funds. Again, to help investors ride out any kind of a inflationary environment where interest rates can rise. So these funds invest in a mix of floating rate bonds and also fixed rate bonds. Right? But if they invest in fixed rate bonds, then they are also susceptible to, if interest rates rise, the price of these fixed rate bonds will fall. So what they do is they go to the derivative market to hedge this in fixed rate bonds, and they'll convert them to floating rate bonds using derivatives. In bond derivatives, uh, instrument called interest rate swaps, which mutual funds typically use to convert a fixed rate bond to a floating rate bond. The mutual fund can take exposure into um, government bonds, corporate bonds, and depending on different ratings as well. And also, the funds take exposure to the swap market, the derivative market, right? To convert a fixed rate bond to a floating rate. Now, the what other? So if you take typically, uh, what are the risks in the floating rate bonds or floating rate funds? Now, the main risk is that the floating rate bonds are illiquid. So that makes the fund also illiquid. Why are floating rate bonds illiquid? And the reason is pricing of these bonds. It is very difficult to price a floating rate bond simply because the market has to factor in where will the benchmark interest rates move over the next 6 months, 1 year, 2 year, 3 year, 4 year, depending on the maturity of the bond. Now that depends on whole host of factors which can go right or wrong. So the pricing itself is very mathematical, but it's subject to a lot of constraints because you would have to have something called forward-looking interest rate yields. And as we all know, anything forward-looking, while at this point of time it can be explained through a mathematical process, never really works correctly. And even in India, there is a lot of issues on deriving a forward rate view on interest rates, largely because there is no clear depth available in the market to generate a good forward interest rate view. Let me I will not go into the explanations behind that. It can be a little too complicated. But just to keep you understand, the pricing of these bonds are very difficult. And when you're buying a floating rate bond or looking to go and sell it, then you are not sure what is the correct price at which to sell. And so typically when the pricing is not correct, then the mutual fund NAV, the pricing too may be difficult to verify whether it's the right NAV or not. It's purely because the pricing of floating rate bonds is very difficult in this market. And also when mutual fund schemes convert fixed rate bonds to floating rate bonds through use of derivatives, derivatives, as we all know, can be extremely volatile. And during many stress times, we are seeing derivatives go all over the place. And when this happens, the funds carry a big mark-to-market volatility. And if investors are subject to this volatility, and NAV will fluctuate widely when derivatives are very volatile, and they are normally volatile in nature, but in difficult markets they can be extremely volatile. And if investors need liquidity from a fund, and as we all know, mutual funds are open-ended, and they will have to sell the bonds to give liquidity. Then they'll have to sell the bonds and close out the swap, which could be in deep loss, and that could hurt the NAV, and investors could end up uh, coming out with much lower returns than expected. So these are the risks in floating rate bonds and funds. And so, if investors are looking to invest in floating rate bonds or funds, they must understand this risk and must ask relevant questions to the financial advisor who typically will be informed of the risks in the floating rate funds and maybe able to convince them or maybe able to give them good knowledge of the pricing of these bonds and the derivatives itself. So that's floating rate bonds and funds for you. And please do make sure that you understand these very well before you invest, because it's not as simple as a investment that will protect you against rising interest rates. Do not forget to subscribe to our Quick Invest. And once you subscribe, you'll get a lot of knowledge as well on bonds, apart from giving you the best bonds to invest in. And also, and give you a very strong, seamless process, of digital process of investing. And also, you'll get a lot of education material through our newsletters like Search for Yields and other education material that will make you a much better investor, and also will help financial advisors help help their clients to take much more informed decisions through the knowledge that we provide them. Thank you very much.